In one of the busiest trading hubs in history, merchants agreed to something that sounds impossible, especially to modern ears, because there were no official prices, no posted rates, and no single authority telling buyers and sellers what anything was worth on a given day. Instead, value emerged through whispers, through repeated interactions, through memory, and through an unspoken understanding that if you cheated today, you would not be invited back tomorrow. And in a market like this, exclusion was a death sentence. Goods moved in enormous volumes, fortunes were made and lost, and trade flowed smoothly, not because the system was simple, but because everyone involved understood its invisible rules, rules that lived in behavior rather than in writing. There were no contracts thick with legal protections, no centralized enforcement strong enough to intervene in every dispute. And yet, the market held together, day after day, transaction after transaction, powered almost entirely by trust and reputation. And for a long time, it worked so well that outsiders assumed it must be fragile, temporary, or secretly corrupt, because systems that look this informal are not supposed to survive at scale. Welcome to Empire Economics, the channel where we explore forgotten economic systems, unconventional markets, and the hidden mechanisms that allowed entire societies to function long before modern finance believed it had solved these problems for good. This is the story of the market that had no prices, and somehow worked. This market did not begin as an experiment, or as a philosophical rejection of prices, but as a practical response to a world where information traveled slowly, currencies fluctuated constantly, and rigid pricing often caused more chaos than stability. Merchants came from different regions, speaking different languages, using different measures of weight, purity, and value, which made fixed prices less useful than ongoing relationships built through repeated exchange. Instead of asking what something cost, traders asked who was selling it, who had bought it before, and how reliably those past deals had been honored over time. Reputation became a form of currency, one that could not be forged quickly, could not be borrowed easily, and once damaged, could take years to rebuild, if it could be rebuilt at all. Prices still existed, but they lived in memory rather than ink, shaped by recent trades, current shortages, seasonal pressures, and the quiet signals passed between experienced traders who understood how to read the room. Disputes were settled not by courts, but by exclusion, because anyone known to cheat, mismeasure, or deceive would find themselves gradually shut out of future trades. And in a network this dense, isolation was economic ruin. What emerged was not chaos, but a flexible system capable of adapting faster than any centralized authority could manage. One that balanced self-interest with survival in a way formal rules often struggle to achieve. In a market without posted prices, trust did more than smooth transactions. It replaced entire layers of structure that modern economies take for granted, quietly handling risk, coordination, and enforcement all at once. A merchant who consistently delivered fair measures, honored delayed payments, and resolved disputes without escalation became someone others sought out, not because they were cheaper, but because uncertainty carried a cost far greater than any small difference in price. Over time, these relationships formed dense networks, where information about behavior traveled faster than goods themselves, allowing traders to adjust terms instantly based on reputation alone. Someone newly arrived could trade, but only cautiously, with small volumes and limited flexibility, until they proved through repeated actions that they understood the unwritten rules governing the market. This created a natural barrier to entry that discouraged opportunists, because short-term profit was always outweighed by long-term exclusion, and patience became the price of participation. Trust, in this context, was not blind. It was conditional, constantly evaluated, and continuously updated, shaped by every interaction, every delay, every gesture of cooperation or conflict. The result was a market that behaved predictably without ever appearing rigid, one where value adjusted smoothly because belief itself acted as the stabilizing force. As the market expanded, its reliance on trust began to encounter pressures it was never designed to handle. Not because the system was flawed, but because scale changes the meaning of relationships in subtle and dangerous ways. Where traders once recognized each other by name, voice, and habit, they now faced strangers whose reputations were incomplete, delayed, or distorted by distance, making trust harder to verify and easier to fake. Volume increased faster than memory could keep up with, and the informal mechanisms that once filtered bad actors struggled to process the sheer number of new participants entering the system. Small misunderstandings, once resolved quietly, began to compound, while isolated acts of dishonesty echoed more loudly through the network, undermining confidence far beyond their immediate impact. Veteran merchants responded by tightening terms, shortening credit, and favoring familiar partners, which unintentionally reduced flexibility and slowed the flow that had once made the market so resilient. Trust, still present, became unevenly distributed, concentrated among inner circles rather than shared broadly across the market, creating fractures that were difficult to see but impossible to ignore. The system was still functioning, but it was no longer forgiving, and in an economy built on belief, that shift mattered more than anyone realized at the time. The real damage did not come from failure within the market itself, but from attempts to copy its success without understanding the fragile balance that made it work in the first place. Outsiders saw efficiency without rules and assumed structure was unnecessary, believing trust could be scaled, transplanted, and accelerated simply by encouraging participation. New markets adopted the appearance of informality, removing safeguards while lacking the dense social memory that had disciplined behavior in the original system. Participants entered expecting flexibility without accountability, unaware that trust was never free, but earned slowly through repeated exposure to risk and consequence. Where reputation once accumulated over years, it was now inferred instantly, based on proximity, enthusiasm, or volume, allowing unreliable actors to move quickly before their behavior caught up with them. As imitation spread, failure followed, and confidence eroded not just in the copied systems, but in the original market as well, as trust weakened under association. What had once been a quiet, adaptive mechanism now carried the weight of expectations it was never built to support, and the strain began to show in places few were watching. As confidence weakened, trust began to change character, shifting from a stabilizing force into a hidden source of risk, because agreements that once reduced uncertainty now concealed it. Merchants continued trading on reputation, not because it was still reliable, but because abandoning it would have meant admitting the system itself was no longer safe. Credit extended longer than prudence allowed. Disputes were overlooked rather than resolved, and warning signs were quietly reinterpreted as temporary disruptions rather than structural stress. In a trust-based economy, hesitation spreads faster than panic, because participants sense when belief is being maintained through habit instead of evidence. Transactions still occurred, but the tone had changed, with traders hedging emotionally, even when they appeared cooperative on the surface. Every deal now carried an unspoken calculation, not just about profit, but about exit, about how quickly one might need to disengage if confidence collapsed entirely. What had once been a shared assumption of continuity became a series of individual survival strategies. And that quiet shift marked the beginning of the end. The collapse did not begin with a dramatic failure or a single catastrophic betrayal, but with a subtle change in behavior that most participants felt before they could explain it. Merchants who once arrived early began arriving late. Those who had offered generous terms quietly tightened them, and conversations that used to flow freely became cautious, clipped, and deliberately vague. Trust did not vanish all at once. Instead, it fragmented, breaking unevenly across the network as individuals responded to the same uncertainty in different ways. Some rushed to secure their positions, others froze and waited for clarity, and a few attempted to extract as much value as possible before conditions worsened, accelerating the very breakdown they feared. Because prices had never been fixed, there was no clear signal to announce collapse, only widening gaps between expectation and reality, where trades failed not loudly, but quietly, one after another. The system had depended on shared belief more than shared rules, and once that belief became conditional rather than collective, coordination itself began to fail. By the time participants openly acknowledged that the market no longer worked as it once had, the mechanisms that could have restored confidence were already gone. Once the system fractured, rebuilding it proved impossible, not because trust had disappeared entirely, but because the shared conditions that once allowed it to function no longer existed. Too many participants now remembered loss instead of reliability, and memory, in a trust-based economy, weighs more heavily than optimism ever can. Even honest merchants found themselves trapped, forced to prove credibility in an environment where proof required exposure, and exposure now carried unacceptable risk. Any attempt to restart the old practices immediately attracted opportunists, because the reputational filters that once discouraged bad behavior required time, continuity, and patience, none of which the market could afford anymore. Formal rules were proposed, but they arrived too late and applied too unevenly, disrupting the flexibility that had once compensated for their absence without providing enough stability to replace it. What had worked because it was organic could not survive being institutionalized under pressure, and efforts to impose structure only highlighted how much of the system's success had depended on invisible, unrepeatable conditions. The economy had not failed because trust was naive, but because it was precise, contextual, and fragile. And once removed from its original environment, it could not simply be recreated elsewhere. What this economy revealed, long before economists had the language to describe it, was that trust does not scale in straight lines, and systems that rely on it cannot be expanded, copied, or accelerated without fundamentally changing what makes them work. Modern analysis often treats trust as a variable, something that can be increased through incentives or reduced through safeguards. But in reality, it behaves more like an ecosystem, shaped by history, memory, repetition, and shared expectation. In the original system, trust functioned because failure was personal, visible, and remembered, meaning behavior carried consequences that extended far beyond any single transaction. Once those consequences became diluted by distance, anonymity, and volume, trust stopped acting as coordination and began acting as assumption, which is far more dangerous. The market did not collapse because people became dishonest, but because honesty alone was no longer enough to hold the system together without the social infrastructure that had once reinforced it. Every attempt to formalize or replicate the model misunderstood this distinction, mistaking outcomes for mechanisms and efficiency for stability. In that sense, the economy did not fail. It revealed a boundary, showing exactly where human-scale cooperation ends and where abstraction begins to erode it. The tragedy of this economy is not that it collapsed, but that it worked so well, so convincingly, and for just long enough that others believed its success could be reproduced simply by repeating its visible behaviors. What they copied were the transactions, the agreements, and the surface-level mechanics, without realizing that the true foundation of the system was invisible, slow-moving, and impossible to accelerate. Trust had been built through years of repetition, shared memory, and mutual exposure to consequence, not through design, policy, or incentive. Once outsiders attempted to scale it, formalize it, or extract its efficiency without accepting its fragility, the system became something else entirely, still recognizable in form, but hollow in function. This pattern would repeat again and again throughout history, in markets, institutions, and technologies that mistook cooperation for compliance and belief for certainty. The economy did not fail because it was flawed, but because it revealed a truth that remains uncomfortable even today: that some systems only work when they remain small, slow, and deeply human. And the moment everyone tries to copy them, believing they have discovered a shortcut, that very belief becomes the reason they can never work again.